All right, good morning, everybody. It's 11 o'clock. As usual, I've got a bit of news to run through first, but then we'll be talking to John Forster from Impax Environmental Markets. So news-wise, four things I pulled out. There's quite a lot going on still. So those four there we'll run through in order. The QuotedData's European renewables first. This within the renewables sector is not a particularly big fund, so only £260 million. It's sort of slightly late to the party, and I think if it had launched earlier, it would have been bigger. It's been trading on a discount ever since rates started to rise, which is not unusual within the sector, and that's pushed it onto quite a big yield, about 8.4%. What they've been doing, they've sort of been wrestling with it for a long time now, because they had a continuation vote built into the structure in June 2023. There was a sizable-ish vote against. That's of those voting, not of the whole register. I think it was about 19% of the register, and that obviously was a bit unnerving, but probably understandable given where we were at the time. But then in December, Octopus Renewables, sort of out of the blue a bit, proposed merging with the fund, and they had to defend themselves. So they announced a strategic review, and various things have happened since then. So they actually started talking to people on the basis that some of them might be a takeover. Then all that got scrapped, but there was still a proposal perhaps from the investment advisor. That was updated on the 19th of August. But on the 12th of September, the company came out and said, look, we can't get numbers to work on a bid for the company or a merger with another fund. So we think the best option is to do a managed wind down. They've been talking to large shareholders all the way through the process, so we shouldn't see a repeat of what's been going on with other funds in similar situations. I think everybody's on side with this. So the idea really is to focus on maximising the proceeds. So it's quite a disparate portfolio. So it's got wind in Greece, solar in Spain, hydro in Portugal, wind in Norway. It's not the sort of thing that most people want to buy the entire portfolio, and that was kind of the idea, was to build a diversified portfolio so they were all performing at the same time in the same way. But nevertheless, that meant that nobody really wanted to buy it as a package. I do think that the recent sale that they announced, so they sold a stake in a Norwegian wind farm at a premium to NAV. That's really quite encouraging on this front, but I don't think you can extrapolate from it. So I wouldn't say we necessarily get a premium to NAV at the end of it. But I'm not too despondent about whether they'll get NAV or not. I think they should be able to do that. There's no news on the timing of this. That will come later. But they're already, with the Tesla money, paying off the floating rate debt balance. That's going to cut gearing. So the first few sales will go to cut gearing, and then we'll start returning cash. So I think, watch this space, but this one is definitely a goner. And so is this, unfortunately. This is a fund that we really quite liked, Gulf Investment Fund. It's not very big, and there's a good reason for that we'll come on to in a minute. It's trading quite close to asset value, and it has done for a long time. And it has a decent yield, which on an equity fund like this is unusual, but there we go. And it's also within the global emerging markets sector, the best performing. So what I've done here is rank them by 10-year numbers, but you can see that it comes out top on over 5 years as well, and over 3 years. So this is really quite a good performing fund, and that's obviously because of where it's investing in the Gulf region. But also because the manager's been very good at outperforming the local index. They are way, way, way ahead of the local index, and sort of on an alpha basis, if you want to think of it like that, it's probably one of the best funds I've seen in a long time. But it is going now, unfortunately, and the reason is this 100% tenders it's been doing. So it kicked off in November 2016. They did a 12% discount tender at 1% discount, and that was when it was Qatar focused fund. But they broadened that out in December because there was a lot going on with Qatar that it had kind of fallen out with its neighbours, and it didn't really make sense to try and focus just on one country there. And at the time that they did that, they implemented another 10% tender. And in exchange for doing a discontinuation vote in 2018, they introduced 100% exit opportunity in 2020. All of that, to me, is sort of reasonable. It's a lot of tenders going on, but still, the idea that you could get out the whole thing in 2020. Now, if they'd said we'll do the same thing again in 2025, to me that would make complete sense, and every 5 years thereafter. But instead, they've been running since November 2020, 100% exit opportunities every 6 months, and honestly, it's just suicidal. And it fundamentally goes against the whole point of having a closed-end fund. If the managers constantly have to worry about there's going to be chance that money's going to flow out the door every 6 months, it just kills that kind of long-term investment idea. So I think it's massively counterproductive, and it was a massive mistake by the board. There we go. Anyway, so the latest news is it will now shrink below this kind of self-imposed 38 million share minimum, and for the tenders that they've received so far for the latest tender offer. And so they've withdrawn the tender, and instead they're going to hold a meeting just to put it into liquidation. And because the portfolio is relatively liquid, because it's had to be because of these things, it should all get wrapped up quite quickly, and we'll just say goodbye to it. Yeah, it's a great shame, but there we go. Keystone Positive Change. Now this has been a bit of a disaster, as we all know. It's not very big now. It's trading relatively tight, but that's really because I think people saw something like this coming, and it's been buying back a lot of stock. It doesn't offer much of a yield now, but obviously it used to, and that was the whole point of it until Bailey Gifford took it over. And to give you the same chart, but for global sector, again, ranked by 10 years, it's way at the bottom. It's been pretty awful over the past 10 years. And the problem was that it basically switched what it was doing almost at completely the wrong moment. So in December 2020, it was a UK equity value style fund. It wasn't performing very well. 10-year numbers were still okay ahead of the benchmark, but 5-year was way behind. Shareholders were sort of upset, fair enough. And Tesco was obviously having its own problems. And so the board said, okay, we don't think people want UK equities anymore. We think global IT is much better. And also, we think that there is a growing need for a fund focused on kind of responsible and sustainable investing, so ESG type investing. And that probably was sort of flavour of the month then, and it all kind of made sense. And they appointed Bailey Gifford, and investors got quite excited about that, and he did trade at a premium for a bit. But then, as we know, everything fell apart. And so what they've come up with is a potential rollover into the open-ended equivalent, Bailey Gifford Positive Change Fund, so this is basically what we call unitization. This hasn't happened in our sector for a long time. It is the sort of killer blow, if you like. It's almost impossible to compete with, because if you just put something into an open-ended vehicle, you can get out at NAV. So whatever cash you offer, it's never going to be any better than this, really. So I think it will just this is going to be what's going to happen. There is a wrinkle in that it's still got 4.3% in its portfolio in private companies, and they aren't going to go into the open-ended fund. So we'll have to see how they work that. There may be a way around it. We'll have to wait and see. There's talk about providing a cash exit option at a discount. I don't really understand that, because you should be able to roll straight into the open-ended vehicle and then get asset value. There's no exit fee on the open-ended vehicle. And if you want to cash in, that would probably be my preferred option, unless it trades at asset value beforehand, in which case you sell it in the market. Then what used to be JP Morgan Russian, we know the war. and then it goes to trade at a massive premium because it's valued all its Russian assets at zero, and there's a bunch of investors who think that that's all going to come good and they're going to get their money back for the Russian stuff, and so therefore it merits a big premium. And it's almost like a punting stock. There's a lot of to and fro in this, and the share price is very volatile, and it's currently on 108% premium. But that is a way down where it was not very long ago, and there's a good reason for that. So it kind of comes down to the impact of sanctions on Russia. And there's a whole bunch of assets that are held in New York that are, before the war, belonged to VTB Bank, which is a Russian bank, and it is suing JP Morgan in Russia to try and get that money back. And that's obviously not going to succeed in the way it's going it, but they're effectively suing JP Morgan Bank International in Russia, which is the sub-custodian for JP Morgan Emerging Europe, Middle East and Africa. So it looks as though there's a good chance that that sub-custodian will become insolvent. If that did happen, because of the sanction regime, there's no way of transferring the assets that JIMA has into another sub-custodian. There's something going on in the background where they've sort of published a law that says we may be able to just take assets and compensate ourselves for your unfriendly actions. And so that might provide an excuse around this just to nick everything. And what we're talking about is a big chunk of JIMA's assets. So 26 stocks rate zero, 25 million cash, 7.9 million of dividends receivable. If all of that gets wiped out, there really isn't an awful lot left. And I think JIMA will be the next one out the door. Because really they're only keeping it going on the hope that maybe they will get that back at some point. If that became certain that was never going to happen, then there'd be no point in keeping it going. So there we go. It's not going to happen yet. The court case is being postponed. They have a right of appeal. Yeah, we'll just have to wait and see what happens. I'm not sure I'd put 100% premium on the current share price. That's enough from me. We are now going to talk to Impax, and hopefully a much happier story. Good morning, John.
Hi, James. Thanks for having me.
Thank you for doing this. As usual with these things, I'm going to let you talk first. Just tell us a bit about Impax, please, and then we'll come to some questions. And if you've got questions, please put them into the chat function in YouTube. Over to you, John.
Fantastic. Great. Thanks a lot, James. So first up, a couple of compliance slides, which we'll take as read. But if we go straight on, first of all, just on the team, to introduce myself. So my name is John Forster. I'm co-portfolio manager for Impax Environmental Markets. I joined Impax in August of 2000. I've been working with Bruce for 24 years, focused exclusively on investing in environmental markets. I do believe that it's one of the most compelling investment opportunities out there and currently out of favor. Outside of that, we were joined by Fotis getting on for 10 years ago now. He did a fantastic job on picking stocks and joined us as a portfolio manager 3 years ago. But it's not all about us. We've got a fantastic global platform for research. You can see we've got 51 analysts and portfolio managers looking at stocks. We're supported by various other teams, which takes the total investment team up to 85, which is present in Europe, the US, and also over in Asia. So very pleased and proud of the team that we've assembled over the years to help people get exposure to this environmental market story. So that's the team. If we move on quickly to the snapshot. So what is Impax Environmental Markets and what is it trying to achieve? So it's a trust that's looking to provide investors with exposure to the growth of environmental markets. So in terms of what we're trying to achieve, it's all focused on growth and performance. we do have a significant net environmental benefit that you could attach to an investment in the fund. But just to be clear, the focus is on performance. Outside of that, we're invested globally across a diverse range of environmental markets you can see on the right. In terms of focus, we feel the trust is pretty unique with its small and mid-cap bias. We're only investing in proven profitable businesses, but it's $13 billion of weighted average market cap. So it's at the small end of the scale, which is quite unique in the market. As I said, it's very pure exposure to this growth opportunity. There's a minimum of 50% environmental revenues in any holding. And if you looked at the average in the portfolio, it would be 75%. So again, pure exposure to environmental markets growth. Outside of that, well-diversified portfolio of around 60 stocks. In terms of assets, we've got 1.1 billion pounds of assets under management. So it's large and relatively liquid. We have an excellent board, which went through a big refreshment cycle recently. So they're very engaged and chaired by Glenn Suarez. Outside of that, I'd just mention in terms of discount, the trust trades on an 11% discount to NAV currently. The board has been very proactive on buybacks recently. And so that's kind of where we are on discount. Outside of that, in terms of gearing, we've got about 7.5% of net gearing in the trust at the moment. Sorry, that number's missing. Obviously, that's a feature of trusts. We did take the gearing up a notch just over a year ago, and we expect that to contribute to performance over the long term. So that's the overview. If we jump to the next slide. So just quickly on the thesis of environmental markets, the overarching thesis is that in a world with growing populations and rising living standards, this creates a kind of ever-rising demand for growing demand for products and services. Against that backdrop, companies that are providing services which enable the cleaner and more efficient delivery of basic needs like food, water, and energy, and companies that are helping to address environmental challenges like climate change, pollution, etc. Our feeling is that these companies are going to grow earnings faster than the global economy, and that we can translate that to long-term outperformance of global equities. The other way to think about it is this slide here, which we call a transition to a more sustainable economy. There are very potent drivers of that change, these disruptors that you see in the middle of the slide. So the falling cost of technology across environmental markets, you could add to that the emerging driver from artificial intelligence. That driver is definitely alive and well. Consumer preference has joined as a very potent driver for our markets over the recent years. So if you think the VW Dieselgate scandal, the war on plastics, etc., these are big changes in the global economy where we are investing in the companies providing the solutions. And then finally on regulation, we talk about a ever-tightening ratchet of regulations across environmental markets. So energy efficiency standards only get tighter over time, and that's a very potent driver of growth. While we're here on policy, obviously there was a huge momentum on environmental policy as we came through COVID, the drive towards net zero, etc. So, have we seen some governments, some countries delaying some of these targets? Yes, we have. Our position is it doesn't change the destination of where the global economy is heading to, just the pace of change. Outside of that, we have the US elections, which we can talk about later if that's of interest. But again, that's not something that we are overly concerned about. So we can come back to that if we like. So that's the basic thesis. If we jump to the next slide, in the interest of time, maybe next one down. Just to look at, okay, so what are environmental markets? This is our classification system, which breaks it all out. So a quick run through. So we have the energy sectors, which comprise the renewable energy markets, but also, more importantly, energy efficiency, which is everything from the grid investment, energy storage, industrial energy efficiency, a broad range of markets we can invest in. We have clean and efficient transportation, which in particular includes the electric vehicle opportunities. Smart environment is quite dominated by what we call digital infrastructure, which is all about the artificial intelligence exposed names. So there is some hardware in there, but also a lot of industrial software, which is improving the efficiency of industrial value chains. We've got water treatment and infrastructure. We've got a diverse range of opportunities around what we call the circular economy. That's everything from product design software to sustainable materials to sharing economy business models like equipment rental to then waste management and recycling at the end. And then finally, sustainable food and agriculture is a group of sectors that are improving efficiency and reducing the environmental impact of what's a very resource-intensive activity. And again, it's very diverse, from sustainably managed forestry to natural and organic ingredients to fiber-based packaging. So I spent a bit of time just to give people a flavor of the spread of opportunity that we're looking at. If we jump to the next slide, take it a level down. In terms of universe, we're looking at this dark blue block within this slide. So we've got 1,500 names to choose stocks from, north of $6 trillion of market cap. So it's a large, rapidly growing, liquid universe to pick stocks from. If we then move on, so that's the introduction to environmental markets. If we turn briefly to performance, obviously a lot of numbers on this on this page, but if we maybe focus on the bottom, the key message would be that we'd had consistent, strong performance throughout the teens, which was driven by a kind of globalization of environmental markets and broadening spread of performance across the markets we've just discussed. We had standout positive performance between 19 and 21, contributed to by this drive towards net zero. That did leave some valuation challenges in some markets and a portfolio re-rating that left valuation at the high end in 2021. The last 3 years have been, that I'd say that left a difficult starting point for the last 3 years of inflation and rising interest rates. Obviously, that drove some rotation towards value, whereas our focus of the fund is definitely on growth. And it also created a much more difficult environment for small and mid caps. So I would say we've been here before in these periods of very strong out and underperformance. So I think that's probably all I could say on that. But if we zoom in a little bit on the next slide, this is a waterfall for the 12 months to June, which takes you from ACWI to the performance of the specialist strategy to which IEM belongs. You can see, just to stick to the key issues, key messages, a substantial headwind from not owning the mega cap tech, and also some puts and takes on environmental markets. We have had very strong performance in our digital infrastructure names and also in names exposed to construction activities. That's buildings, energy efficiency, and water infrastructure. In terms of the headwinds, we have some sectors that are suffering what we call temporary headwinds in their markets, quite often around destocking, but definitely starting to see some green shoots in some of those markets. So the renewable power utilities, or IPPs as we're calling them here, that used to be a much bigger headwind, but the performance has been better. I think it's also impacted by M&A activity within those markets. So private equity stepping up and seeing value in these markets. Secondly, we used to have a red block here for natural ingredients names that were also struggling through some destocking trends. Those names have turned the corner and would be sitting on the other side as a green sector. So some puts and takes, but the history is that as sectors work their way through these headwinds and turn a corner, that can unlock good performance. So that's just a bit of color on the more recent performance. If we go to the next slide, this is another way of looking at it. If you deconstruct performance and you strip out the dividend, you take account of the change in valuation. What's left is implied earnings growth. So we've done it over the medium term, let's call that 3 years, and long term over 10 years. And given the challenging period of performance, the message is that the implied earnings growth over 3 years has been very similar to global equities or ACWI, and has been actually kind of slightly better over 10 years. So typically a couple of points of extra growth. So, again, from a high base, we've been really struggling with this kind of relative derating over time. So that's that. If we go to the next slide, conscious of time. So this is a portfolio snapshot, well-diversified portfolio of stocks, diversified by sector and region, and with a good balance between more cyclical and more defensive stocks. You can see the weighted average market gap of $13 billion. And so this fairly unique focus at the small end of the scale. I'll leave that there. If we jump to the next slide on top 10, just to bring a few names into the piece. So DSM-Firmenich is one of our natural ingredients holdings. Again, it had some headwinds in some of its end markets, particularly areas like vitamins and animal feed, starting to turn the corner in those markets. It's also merged with another group called Firmenich, which takes them into natural flavors and fragrances, which is a compelling synergy opportunity, compelling cross-selling opportunity as well. So that is DSM-Firmenich. A second name, PTC, is one of our industrial software holdings. They're focused on product lifecycle management. That's basically product design software, manufacturing software to improve the efficiency of manufacturing, and it also ends up in capital goods. So you think of a machinery in a factory, it's involved in predictive maintenance, so forecasting when to replace components and avoid the machine breaking down. So that's what PTC does. And a final name, Clean Harbors, is the US market leader in industrial hazardous waste. It's a very highly regulated market. It's impossible to get a permit to open a new plant. So strong barriers to entry and some compelling growth opportunities through onshoring of manufacturing back to the US, the closure of captive treatment facilities within their industrial customers, and also this, PFAS, the forever chemicals that see quite a lot of profile in the press. That's a emerging opportunity for them. So that's what Clean Harbors does. So that's just to bring it a little bit to life on a few names. I think we'll take the trading activity as read, but I'm happy to come back to that in terms of what we've been up to, if that's of interest. But if we just jump to the outlook, most importantly, we feel the underlying thesis of environmental markets that we discussed earlier on is fully intact, but just out of favor. Secondly, on the macro side, the inflationary and rising interest rate environment has been challenging. We're looking forward to turning the corner and moving into a phase of falling interest rates, which should be beneficial for size and style. It is a very different portfolio compared to most other holdings, and we feel very constructive about growth and valuation. So I think that's what I'd say. I hope that wasn't too long. I think that's about 15.
No, perfect.
James, pass back to you.
Yeah, no, perfect. So good. Let's run through some questions. I think actually, let me leave it on this one or the one before. There's quite a big universe you've got here. Actually, let's go back to that slide. There we go. So yeah, 2,600 stocks. How do you whittle that down to come up with what goes into the portfolio? So what is it that you're looking for, particularly that would make one stock go in and another one not?
Yeah, we've got a very kind of defined and structured process for getting from a universe to a portfolio. So after you've created the universe, the investment team takes a look at the stock and decides, is it interesting? So we're looking for, what are we looking for? We're looking for growth. We're looking for a strong business model and strategy. We're looking for a management team with a proven track record. We're looking for strong financials, and we're looking for a name that we feel that the growth and margin outlook is not reflected in valuation. So that's what the pair of analysts will look for. Once the initial work has gone, we have a detailed due diligence phase that ends up in an investment committee where we decide, does this have the quality to go into portfolios? That's called a 10-step analysis. One of those steps is also an in-house ESG analysis to make sure we're comfortable on ESG quality. But that's what gets you to what we call our A list or approved list, which would be about 250 names. And that's what we're picking our portfolio from, is from that A list.
Okay, fair enough. If we then look at some of these sectors, where are we?
Yeah, you need to go up a bit. There you go.
There we go. So we've got some specific questions on some of these. Firstly, solar, because I think when you were looking at the returns, there's the sort of a red bar for solar. What's the headwind facing that part of the market at the moment?
Yeah, I think solar would be probably the sector where the headwinds have been biggest and most long-lasting. So we can't say that that sector is turning the corner. There's a few issues. First of all, there's been some regulatory change in the US, in the key Californian market, which caused disruption to growth in that market. High interest rates have been an issue in some markets in terms of denting the economics of solar. And the other thing is, it's like many sectors, they've been struggling with destocking. So there was a huge amount of inventory that built up both in North America and in Europe, and it's taking time for that inventory to flush through and get back to a normal market. So it's definitely taken longer than expected. But again, the cost of solar technology is very low these days. It's sometimes quite often the cheapest power you can generate. These issues will come to an end, but we're not, given the lack of transparency in the markets, we're not calling an end of that headwind yet, but we are keeping our holdings and following them closely on the way through. But that's what the challenge has been.
Couple above that, do biofuels stack up without subsidies, and are they actually just diverting resources away from agriculture?
Yeah, when it comes to biofuels, it's not a sector overall that we particularly like, because you tend to end up with reliant on subsidies. You're also exposed to completely uncorrelated commodities on the way in. So whether it's soybean or corn, etc., and then the bioethanol or biodiesel on the way out. So there are quite a lot of risks attached to that we don't really like. But what you can find is advanced biofuel companies that don't have those kinds of exposure. So Darling is a name that we own in the portfolio, which basically has a whole bunch of rendering plants in North America that treat butcher, abattoir, and bakery waste and convert that into advanced biodiesel. So that's a much more compelling opportunity with a better raw material source that's not exposed to the issues that you've highlighted. Does still have exposure to policy at the kind of end in terms of the sale of biodiesel, but there's some quite interesting changes and drivers in those markets, like sustainable aviation fuel, which we think mean that's an interesting area for investment.
Okay, thank you. A lot of the portfolios in the US does the election outcome worry you potentially? Is that something you need to focus on?
Yeah, it's a good question. So I think the first thing to say is we have been here before. So when Trump was first elected, we had similar question of, is this the end for environmental markets? And over the following period, we actually significantly outperformed global equities. So obviously it's a very close race at the moment, and hard to call. But even if we take the Trump win as a scenario, we feel that I think everyone has got very negative what that actually means for environmental markets. So first of all, people worry about the Inflation Reduction Act, which targeted huge amounts of money into environmental markets. We don't see a full cancellation of the IRA. They might slow down. They're probably going to slow down the flow of funds into some markets, but I don't see a full cancellation of those markets of that funding. And it's definitely true that we can't say that Trump would be good for environmental markets. He's got a history of constraining funding to the EPA, etc. But federal policy is only one driver in North America. You do have a lot of state and local policy which remains supportive, and you do have a lot of corporate decision making. Like the tech large cap names who are driving towards 100% renewable energy in their data centers. So it is something to monitor, but I think it's something that people have become a little bit maybe kind of too worried about. So that's what I'd say on the US elections. Yeah.
Great, thank you. On water, there's a question here.
Mm-hmm.
It's really around so what are the sort of challenges, but I guess opportunities for you of the problem of water scarcity brought on by climate change?
So, I mean, I think water volatility is really what we're seeing. There is as climate change has accelerated, you're seeing volatility of water resource. So it's not just droughts; it's droughts followed by floods, followed by droughts again, and that places a huge amount of strain on infrastructure and means a huge amount of investment needed to strengthen infrastructure and put it on a footing that can deal with these more volatile conditions. So it means investment in water infrastructure. It means kind of better investment in storage. This is something that the UK is going to be wrestling with over the coming years as well, and it involves also more careful monitoring of where it's being used. So advanced metering, leak detection to make sure that we reduce the leakage rates in the current infrastructure. All of these things will be part of improving the resilience of our water infrastructure to these trends. So it's definitely a huge challenge going forward.
And then probably last one of these, sustainable forestry. Can you tell us a bit about that? Because I know that gets sort of negative headlines from time to time about whether it is really sustainable or not. I know we get questions about Drax here, but this question is actually mentioning Rainier.
Yes, that's right. So our holding in the fund is Rainier, and so but taking a step back, forestry, sustainably managed forestry, we believe is a compelling opportunity in environmental markets. Obviously, the forestry assets are an important carbon sink, but it's been shown that how you manage your forestry makes a huge difference. So there are areas like Canada where the forestry was held in government hands, where they did a poor job of managing it. They had a huge amount of beetle infestations and destroyed vast tracts of forest land. So if you do a good job of it, manage your forests to the highest sustainability standards, it can make a huge difference to the health of those forest lands, their resilience to wildfires, etc. So Rainier is exactly that company. It's all of its forest lands are certified to international standards, and it does a fantastic job of managing them and acquiring and disposing of assets. So it's a very well-run business.
Great, thank you. Now then, just think about what you've said here about the outlook. So we are hopefully going to get interest rate cuts. Will that make a massive difference, do you think, to valuations in your sector?
Well, we are focused on growth investments, and we also have, if you look at the profile of the fund, we've got quite a lot of long duration assets and utilities and the like. So these are all sectors and categories that have struggled in a high interest rate environment because you're discounting those future cash flows at a higher rate. So, our feeling is that as interest rates come down, that situation should normalize. So, that's a kind of top-down thesis. Small and mid caps have had a very torrid time over the last years. Some people wonder if it's going to go on forever, but nothing goes on forever. No, so we think that particular size should benefit over the longer term, and we're starting to see some tentative signs of performance in the utilities, for example, which I think are starting to react to the outlook for falling rates. So I guess the question is, how quickly do the rates come down, and how does that compare to what the market expects? But having had this extraordinary period of rising rates, we're looking forward to at least being on the other side of that curve.
Yeah, great. And one of the other things we've seen in other sectors where we've got these smaller caps out of favour is a lot of M&A activity. Are you seeing the same thing?
Yeah, we are. It's very interesting. There's a long history of M&A in environmental markets across in the 22 years we've been managing the trust. It's particularly been large industrials looking to gain exposure to the growth of these markets by buying out our holdings. We hadn't had any of that activity for quite a long time, but we've had two companies bid for during the second quarter. If you think about sectors, I think as I mentioned earlier on, there's been a lot of activity in the renewable power kind of project developers. So that's definitely a sign of value. And we had a name called Turner Energy, which is focused in Greece, which has been bid for. And then we also had a second name called Stericycle, which is a US medical waste player, which is being bought by Waste Management. So I don't think it's a coincidence that this coincides with a period of de-rating and more attractive valuations. So otherwise put, it's not only us saying that we feel that valuations have come down a long way. It's also the corporates and private equity funds stepping up and snapping up these assets. So it's quite interesting.
Yeah, great. Looking at these recent trades here, is there any kind of pattern to these? Is there any things that you're particularly excited about at the moment?
So there's a few themes. So first of all, these volatile markets create opportunities to buy really high quality businesses at much cheaper valuations. So Contemporary Amperex or Cattle would be a good example of that. They are a battery technology company quoted over in China. We think it's interesting because it's a very large company. It's a dominant battery technology company. It's present across all the different chemistries. If you look at its R&D budget, it's billions of dollars. And so, you don't have to worry about which chemistry is winning out because they're involved in all of them. But it's a name that got caught in the downdraft of, China macro, a slower penetration of EVs, etc. So, also all of these trade disputes in different regions. So we did a lot of work to get comfortable with some of these challenges, but we felt with a low double-digit PE ratio, that was a really compelling opportunity to buy. So that's a name that we like. Secondly, Prismian is another interesting opportunity in that just in terms of what they do, they're focused on the grid. They supply cables that go into the high voltage and medium voltage grid, which we think is it's going to need a lot of investment. That's what all of the studies say in order to service the electrification of vehicles and the broader economy, and to cope with an increased penetration of renewables. So that's the thesis behind that one. So those are kind of growth stories, but at the same time, we're trying to balance that by also investing in more defensive business models. So Steris is a good example of that. They provide sterilization services for the sterilization of surgical implements. So it's a very consolidated market in North America. A lot of it's repeat revenues, and again, it's less cyclical in terms of exposure to surgical procedures. But you can see the circular economy argument. So it's a balance of those two themes is what we've been looking at.
That's great, John. Thank you. We've covered a lot of ground. So we should maybe. Oh, that's very busy slide. We should maybe leave it there. But that's a question that always comes up, and it hasn't been put in today, but I'm going to ask it anyway. So, so do you have shares in the trust?
Yes, I do.
Yeah.
Yes, I've got a significant chunk of my pension and also ISA and elsewhere. So I'm well exposed and well aligned, and it's all in the trust.
Very good. Very encouraging. So good luck with it all. Thank you very much for talking us through the story today, and we will get you on again another time. But
fantastic. Thanks a lot, James. Appreciate it.
Cool. Thank you. So we're back next week. We've got our quarterly panel show coming up. We're just talking about really the impact of the new UK government on the UK market. So that's covering, as you can see from the people that are on the panel, covering both the impact on UK equities, but also on infrastructure and renewables too. And so that should be quite interesting. Please do tune in for that. And then we've got a full lineup going through the weeks following that. So thanks very much for your time today. Have a good weekend, and we will see you next week.